This is the Asia Trade. I'm Shery in Tokyo.
And I'm Haidi Stroud-Watts in Sydney. The top stories this hour. The Fed keeps rates on hold as inflation cools and dials back easing forecasts, penciling in just one reduction this year and 4 in 2025.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
The Fed outlook not deterring stock bulls, though, with the S&P 500 topping 5,400 for the first time and the dollar retreating against all its G10 peers. Plus, China's Commerce Ministry slamming the EU's move to slap extra tariffs on its electric vehicles. It's a setback for Xi Jinping's pivot to new productive forces.
Heidi, is all about the Fed right now and that reaction that we're seeing in the markets, because we have now gotten the Fed coming out with what was expected, rates unchanged at a 2-decade high, a 7th consecutive meeting. But the key takeaway, of course, being that change in rate cut forecast, 1 for this year instead of 3 as was expected back in March, and really pointing to that modest progress towards a 2% inflation target. Of course, we're still digesting those core CPI numbers slowing the most for more than 3 years, just a few hours before the Fed.
Yeah, and so interesting that when you take a look at the market reaction to undeterred when it comes to these new levels that we see U.S. stocks hitting. Is this kind of the last burst of energy before the typical summer lull? But let's take a look at what we heard from Jay Powell himself.
We see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant, beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having, the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
And as expected, we are getting the Hong Kong Monetary Authority reacting to the Fed decision, keeping the base rate unchanged at 5.75% as expected, given, of course, that the Hong Kong dollar is pegged to the U.S. dollar and follows what U.S. policymakers do. But take a look at how we're setting up with U.S. futures now, pointing to the upside of 0.1%. And, of course, this coming as we saw that rally again in U.S. stocks. We're talking about topping that 5,400 level for the S&P 500. For the first time ever, another record high. What was interesting was that the market reaction was even more forceful after the CPI numbers came out early in the morning, more so than what the Fed said later in the afternoon, perhaps because we saw core CPI cooling by the most in more than 3 years. We had some risk-on sentiment filter through oil prices right now under a little bit of pressure, but of course we're watching yields as well. The 10-year yield falling towards that 4.3%, although paring back a little bit of those losses as the Federal Reserve Chair continued to speak in the afternoon. Take a look at how we're setting up in the Asia session, because we are watching the 10-year JGB yield as well. Of course, a lot of focus on Friday about the BOJ decision will be what happens to debt purchases. So we have the 10-year yield now falling below that 1% level. We'll see where it goes as we're setting up with the Nikkei futures unchanged at the moment. Sydney futures gaining 0.7%, and the setup with A50 China futures really not a lot of change, Heidi. But of course, we're also watching those China inflation numbers disappointing to the downside. So a little bit of divergence when it comes to other central banks and the price pressures that we felt around the world.
Yeah, that's right, Shery. Let's bring in our next guest to talk more about the Fed decision and the outlook with Sebnem Kalemli-Ozcan, who's a Neil Moskovich Professor of Economics at the University of Maryland, College Park. Really great to have you with us as always, particularly on the morning after the Fed. Does it surprise you that the Fed continues to wind back these rate cut expectations when we know that they are data dependent?
Yes, hi, Haidi. It's great to be back on the show. And no, I wasn't surprised. This is what I was expecting, that, Fed was going to stay put, and that's what they did. They didn't change rate, and I think this is exactly right. It is a data-dependent policy. Although this morning here, the data showed everything is on track, right? Inflation still on a downward path. It is going down, and the economy is cooling. But at the same time, there isn't like any sort of contraction or any recession or any indication of that. It is still a strong labor market. So there is really no reason for the Fed to cut the rates. So they stay put as we were expecting.
And you also say that the dot plot at this stage is becoming less relevant.
Yes, because this goes back to, how everything is just like moves forward, right? I mean, at the beginning of this year, both the markets and the dot plot, we kind of, there was this sense of maybe 4 cuts this year, right? This didn't happen. So now, in fact, even maybe 4 to 5. So now, if you look at, again, both the markets and the dot plot, so it is now just 1 in 2024, and the other 4 move to 2025. So it seems everybody is data dependent, right? So just data, according to data, kind of in terms of the, future path, everybody's expectations is similar, but it just keeps moving forward. So in that sense, I don't think we are getting any new information from that compared to markets.
And does it make sense that they lifted their rates over the long term to 2.8% from 2.6% in March, especially as we continue to see this debate over where the neutral rate lies?
Exactly. So I think really nobody knows that. And that's part of the problem. Why, when you don't know where the neutral rate is going to be in the future, and you also don't know the exact timing of the cuts, because the data, will tell you that, and that is a data-dependent policy. And then two combined, it is very hard to, really give exact timing of the cut and the exact amount, right? Because both the neutral rate is kind of debated, unknown, and also data is coming in a little bit, varying forms, right? I mean, we look at several indicators. They do show that inflation is on a downward path, but at the same time, it is taking a long time for economy to slow down, to cool down. That's the message coming out of the data. So.
What will be the most significant international transmission of U.S. policy, especially with these rate cuts delayed? We're headed towards another BOJ policy meeting, and the Japanese yen and its weakness are in focus as well.
I think international transmission is going to be very interesting, because now we are starting to see differences in these interest rates, right? ECB already cut. Bank of Japan now is going to react also with a consideration on the exchange rate, because dollar is going to be strengthening now. And of course, Bank of Japan does worry about that. So now we are going to start moving into this phase where for major central banks, ECB, Federal Reserve, Bank of Japan, and also I think Bank of England, the interest rates are going to start diverging. That is going to create very interesting and different international transmission patterns. But here I think it's important to watch both of these things, not just exchange rate, but also this interest rate differential. They are going to feed on each other, of course, but I think we have to watch both of these developments and then see which way the capital is going to flow, strengthening or weakening the international transmission of these different policies.
Because of these rate differentials, we have seen the strength of the U.S. dollar continue for a while, right? What does that mean when it comes to risk premia for emerging markets?
I think that's the big worry. I don't think there is a worry in terms of risk premia for advanced economies, but I think for emerging markets there is, because emerging markets traditionally, historically, are the most risk-sensitive bunch. Their capital flows are risk-sensitive. And some of them started also cutting rates. These are the ones that started earlier than Fed, like Brazil, Chile, right? And some of them are still increasing the rate because they still have the inflation problem, like Turkey. And that type of differential combined with risk premia is going to have, I think, serious implications for the most risk-sensitive emerging markets, right? I mean, the ones with the highest spreads, if they stay on the side of really kind of lower rates compared to the higher for longer rates in the US, then they are the ones that are going to lose the most capital flows.
Sebnem, one of the issues that we've seen dominantly in the US, but there's been issues in other economies as well, is this tension between fiscal and monetary, right? Where do you see the biggest tension, and where is this going to create that contradiction in this final part of the cycle?
I think this fiscal monetary tension is an important issue, especially in terms of the coordination of these policies. I mean, one side of this issue is, of course, fiscal dominance. I think that is not that important right now, as long as the countries with a lot of debt recognize that they need to reduce it and they need to make sure they have sustainable levels of debt. So that's an issue on the side. But maybe more importantly, for the short term, the coordination between fiscal and monetary is important. For example, when monetary policy is tightening, if you are loosening the fiscal policy, that's obviously complete disconnect between these two policies, and it's going to work against the fight for inflation. And I think that is something that countries should watch, on top of the fact that high government debts that needs to be reduced over the long run.
How big is the political risk in the U.S., given that we're headed towards presidential elections? And it seems at this point that no matter who wins, if it's President Biden or President Trump, they will both try to really open the fiscal taps. What will that mean for the dynamics of the U.S. economy that has finally tried to tamp down inflationary pressures?
I think the biggest danger here, and again, regardless of who wins, if you do fiscal expansion when at the same time there are protectionist policies that are designed to fragment the world, right? There might be geopolitical reasons behind these type of protectionist policies, but still the final conclusion is going to be the same. If we go to a protectionist world, that is going to be a fragmented world, and that's going to be an inflationary world. So if you are pursuing those type of policies, that is going to lead to less globalization, more fragmentation. And at the same time, you do fiscal expansion, that is going to be, inflation 2.0. We are going to welcome back the inflation problem.
Yeah, we'll continue to watch for that inflation 2.0 that might be a big risk next year. Sebnem, Kalemli-Ozcan, good to have you with us. Neil Moskowitz, professor of economics at the University of Maryland, College Park. And coming up on the Asia trade, we'll have plenty of more conversations on the impact of central bank decisions on markets with guests from Lombard Odier, JPMorgan Private Bank, and Columbia University as well. But first, trade war fears escalate as China threatens retaliation for higher EU tariffs on its electric vehicles. Details next. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
You're watching the Asia trade. Beijing has blasted the EU's move to slap extra tariffs on Chinese electric vehicles, raising levies to as high as 48% from next month. The Commerce Ministry says the EU is ignoring the facts and WTO rules. Our China correspondent Min Lo is in Hong Kong. And Min, we have seen Chinese EV makers really trying to make inroads into Europe. How consequential will these tariffs be, and what companies are being targeted?
Yeah, the tariffs are pretty high. They range from 17% to 38%. That's on top of existing 10% tariffs. The EU had launched an investigation into 3 leading Chinese EV manufacturers, and you can see that SAIC is the hardest hit with 38% tariffs. That's because the EU had deemed this state-owned company as being not cooperative with the investigation. Other car manufacturers will also be affected. They will face tariffs that is a weighted average of these 3, that's 21%. Those that did not cooperate with the investigation will face higher tariffs of 38%. But we know that Europe imports 37% of their EVs from China, and actually nearly half of those are made by foreign brands like Tesla, Renault, BMW, and so we know Tesla is very concerned about this. They have been lobbying EU officials to launch an individual review on tariffs for Tesla, saying that they do not benefit from as much state subsidies as the Chinese manufacturers. And we know that the EC President Ursula von der Leyen had said that they are taking this tailored approach to calculate the tariffs to correspond with the level of damage caused.
At the end of the day, is this likely to achieve the impact that the EU is desiring?
Yeah, certainly it's going to be quite a major hit for the Chinese EV manufacturers, because many of these brands, they are facing a very brutal price war back in China. And so they really need the overseas market where they can sell the cars at a more expensive rate for greater profit margin. But now with these tariffs, they likely have to hike prices perhaps by 5, 10, 15%. That would make their cars less attractive. Their profit margin per vehicle is going to be eaten up. And there's one study by the Kiel Institute in Germany that's estimating that we could see a halt of nearly $4 billion worth of EVs from entering Europe from China. But I think the long-term trend, I mean, look, BYD, they're looking to launch this low-cost Seagull car at under 20,000 euros by the end of 2025. That could be at risk, but the long-term trend, we might see these companies shifting production to Europe. We know BYD is already looking to set up a plant in Hungary, perhaps a second plant somewhere else in Europe. Another Chinese brand, Shery, they're looking to set up a joint venture in Spain with a Spanish manufacturer as well. And we know France as well has been trying to attract more battery production to the country, including from Chinese manufacturers. So that could be the long-term shift in a supply chain that could happen in the coming years.
And Mimin, this comes, of course, just ahead of the inevitable political posturing of the US election in November. There's a lot of talk now about the risk of another trade war. Could Beijing retaliate, and what would that look like?
Yeah, certainly Beijing has already reacted very strongly to this. They said that these tariffs, they lack a legal and factual basis, and it's just weaponization of economic and trade issues. They have previously hinted that they could increase tariffs of 25% on vehicles with large engines, and that could hit companies like BMW, Volkswagen, and some of these German car manufacturers, and the German chancellor as well. They have been some of the most outspoken in criticizing these EU tariffs on Chinese electric vehicles. China also hinted that they could retaliate with tit-for-tat levies on European agricultural goods. They have already launched a probe into European wine, so there could be more of these levies to come in the coming months.
Bloomberg's China correspondent Min Lo there. Let's turn from tariffs to a broad slowdown in sales, because the EV sector is currently facing a wall of worry, and that's forcing manufacturers to recalibrate targets. Bloomberg intelligence indices of automakers' valuations from North America to Europe and Asia are all in the red for the year so far. And a fresh report from our colleagues at Bloomberg NEF putting the number on the slowdown. They see electric vehicle sales dropping by around 6.7 million units in the next 2 years. Now, that's compared with previous forecasts, right? And that's steering the world further off course from the goal of net zero emissions. There's one bright side, though. Plug-in hybrid vehicles are seeing a boom in demand, with sales rising faster than battery electric or conventional hybrid types. Still, Haidi, studies show that such vehicles might actually be emitting more pollution than they're rated for.
Oh, still ahead on the Asia trade, Shery. South Korea set to consider changes to the short-selling ban. We'll take a look at what it means for the market. Next, this is Bloomberg. Government officials in South Korea will discuss changes to short-selling rules on Thursday as they try to decide when to lift the ban on the trading strategy. Let's bring in our Asia stocks reporter, Yu-Kyung Lee, who joins us in Seoul. So what changes in the short-selling system is South Korea trying to introduce, and what are the implications?
Sure. So there was a really important meeting at the parliament this morning between the financial regulators and the key officials from the ruling party, and they're going to discuss some of the rule tweaks that the country is going to introduce once the short-selling system is lifted. And that includes mandating some short-selling data submission by the hedge funds or the investment bank when they start doing the short-selling again, so that the South Korea can monitor in case of any naked short-selling, which is illegal. Now, when South Korea prohibited all kinds of short selling in November of last year, they said the measure, which really surprised the market, was aimed at rooting out naked short selling and other illegal trading activities. Now, the country is trying to respond to this demand request from the retail investors that the country needs to eradicate illegal short selling by introducing decentralized monitoring system that could weed out potential naked short selling. Now, the implications for all of these is that this meeting at the parliament between the government officials and the ruling party is seen as one of the last few steps toward the country's making the decision on the lifting of the short selling ban, which is currently going to expire at the end of June.
Yeah, exactly. So the expectation is for it to expire. Is there a chance that it might actually be resumed, or basically, I guess the question is, when can short sellers return to the market?
Sure. Yeah. So that's the million-dollar question that everyone is on his mind. Now, the market expectation is that the government is not going to allow short sellers back to the market anytime soon. That's because the centralized monitoring system for short selling will not be ready for the next few months. The financial regulator have said that by March of 2025, the system will be ready to kick off. But until then, the market is not expecting that the government will allow short selling again. However, we may have to see what the authorities and the ruling party members are going to discuss this morning, and they may give some hints at when they're going to lift the short selling ban. There was government official financial regulators who were urging that the South Korea should be communicating with more transparency and give more certainty to the investor about the timing of the short selling resumption. So there is a lot of expectations about that South Korea would be making the announcement on the short selling resumption pretty soon.
Our Asia stocks reporter Yu-Kyung Lee there joining us from Seoul. Of course, we have the cusp being one of the top gainers in the Asia session. We'll be discussing Korean stocks. Our next guest actually sees a decent run in that market. Lombard Odier expects also the Fed to start cutting rates in September. This is Bloomberg.
This is the Asia trade, about 30 minutes away from the major market opens. Here are the top stories you should know. China's Commerce Ministry has slammed the EU's move to slap extra tariffs on its electric vehicles, a setback for Xi Jinping's pivot to new productive forces. Those extra tariffs will take levies to as much as 48%, just as Bloomberg NEF sees a sharp decline in the global transition to electrified transport. Markets are going risk on, with US stocks hitting fresh all-time highs as after the Fed kept rates on hold and its inflation cools while dialing back easing forecasts, penciling in just one cut this year and 4 in 2025.
We see today's report as as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant, beginning to loosen policy at this time.
And the focus now shifts to the Bank of Japan meeting, which is widely expected to consider slowing the pace of bond buying. Investors will also be on watch for any signs of a possible rate hike in July. All but one economist surveyed by Bloomberg expects the BOJ to hold its benchmark rate on Friday. Shery.
Yeah, take a look at how currencies are setting up for that big rate decision. Really not doing much because we are trading sideways the entire week. The dollar also didn't really do much. It fell after 4 sessions of gains, but the losses were trimmed after the FOMC adjusted its dot plot to just 1 cut this year from 3 before. And of course, we continue to watch the offshore yuan as well as the Japanese yen remains in focus because we are at decades low, and the Bank of Japan decision is very much being watched right now. It's expected to keep rates on hold on Friday. Investors now honing in on any clues on quantitative tightening that could help support that currency. Here's a look at the broader implications of a cheaper Japanese currency.
Japan is back, attracting people from all over the world with unbeatable deals.
The third time I came, the yen is now very good, so I eat now very, very low cost. And I came here with a backpack with 10 kilo, and now I'm going home with a backpack for 20 kilo, because all clothing that I bought because it's very cheap.
The Japanese currency is trading at levels not seen since the 1990s, and tourists are taking notice.
The Ginza district here in Tokyo has for years been a byword for luxury, just as the rest of Japan has been known for its premium experiences and goods. But with the dollars, pesos, and yuan going much further, plus the 10% duty-free discount, luxury is at a bargain.
But it's not all glitz and glam. For Japanese households and smaller businesses, a cheaper yen has meant real pain.
The price of chocolates and oils has gone up so much. We try to keep the quantity of breads with them to a minimum and make simple breads without imported ingredients.
Companies that depend on imports and rely on the domestic market are suffering from higher costs. And even exporters that would typically welcome a weaker yen are growing uncomfortable. The currency's sustained decline is making business planning more difficult.
A big factor is that when M&A is conducted overseas, we're not purchasing with yen but with local currency. When the price is set in dollars or euro, it becomes much more expensive than when the yen is strong. This has had a significant impact on our business.
And for Japanese towns feeling overrun by tourists, the cheap yen is triggering other interventions. Fujikawa Guchiko has erected a giant black screen to block its iconic views of Mount Fuji. Shery on Bloomberg, Tokyo.
And I'm joined here by our senior Japan economist, Taro Kimura. And we'll try to take a deep dive in the economy because I was out there talking to people, and it seems that really the reaction to how cheap the Japanese currency is pretty mixed, right? I mean, domestic households are feeling the impact, prices are rising. Will the BOJ sort of feel compelled to do something, although they'll probably try not to look like they're reacting to the yen?
Absolutely. The weaker yen is actually weighing on the consumption, and that's why the Japan's GDP is shrinking. That's it. My stance is the BOJ is not reacting to the weaker yen, but absolutely, yes, it's an annoyance for them. My reading is the BOJ, it was like the July hike, my expectation is already in the pipeline when they pivot their policy, but that might look like the BOJ is acting towards the yen, and my guess is for the next meeting, probably the BOJ will start the quantitative tightening and signaling further hikes, and that will mean a kind of 1-2 punch signal for the dollar yen. And yeah, the meeting will be very consequential on Friday. Yeah.
Explain to me how the debt purchase reductions work in terms of helping put a support level to the Japanese yen, because this is what we're really watching this time around, right?
Absolutely. So quantitative tightening means the Bank of Japan will no longer intervene intervene to longer-term JGB yields, and particularly for the 10-year yields. Remember that they were capping it in 0.5 or 1% until March, and it's gone now. And starting the reduction of JGB purchases will make it clear that the BOJ won't intervene anymore. So that will be a kind of sort of mid to long-term upward pressure to particularly to 10-year or longer JGB yields that will be supportive to the yen's rates.
Tara, what could derail this plan?
I'm expecting the BOJ to announce to reduce JGB purchases from current 6 trillion yen monthly to 5.5 million. And I guess they don't take a Fed style. I think they will keep some leeway for them to adjust the reduction amount based on the market condition, because we don't know what's going to happen after they start QT, while the BOJ is having JGB almost nearly its Japan's GDP. But that said, I think the weather will signal that the reduction process will be mechanical, steady, and modest. And I don't think it's going to spook the market.
We have seen them, though, already sort of pare back on their regular bond purchasing operation. So is that sort of already leading the way?
Yes, I think so. Like they kind of cut just 50 billion yen in May, and that wasn't a big spook to the market. But that said, I think it prepared for the market that actually the bond reduction is coming. So I think the market is expecting it, and although QT sounds like a very pivotal policy pivot, but I think compared to the introduction of QT, I think the effect will be asymmetry, and just like it's a gradual process for Japan's market to come back to normal.
Everything is gradual here in Japan, isn't it? Thank you so much, Taro Kimura, our senior Japan economist, really satisfying all my curiosity about what to expect from the BOJ. Of course, we are expecting the BOJ to tighten policy further in the coming months. Our next guest sees the U.S. dollar, though, remaining strong. Homin Lee is senior macro strategist at Lombard. Odier, Homin, great to have you with us, because that would really pressure the Japanese yen, right? But Homin, let me get started with the U.S. economy, because I do want to get your take on what you thought about the FOMC policy decision and whether you're still liking the U.S. markets, given that we've seen another rally and another record high.
Well, we have seen the round trip in the financial markets in reaction to the CPI print first, and then FOMC. Median projections showing just one cut for 2024. But we would actually, from our perspective, the FOMC meeting gives us more conviction that there will be cuts by the U.S. Federal Reserve at some point in the second half of the year. And also, CPI print, shows us that data are now in the driving seat, really. So regarding the CPI print, we think that's consistent. We'll have to see the export-import inflation in the coming weeks, but that's consistent with the core PCE reading of roughly 2.5%, which is lower than the April reading. And the FOMC meeting, even though the median projections surprised markets a bit, we want to highlight that the largest block of voters in the FOMC, they still look for more cuts. And also, it's pretty important to understand that the FOMC is thinking about 4 cuts next year, despite the fact that the landing zone for inflation at the end of next year is expected to be slightly above target. So there is this bias by the FOMC to cut, and that's more interesting from our perspective than the median projection moving from 3 to 1. So overall, a constructive combination of CPI and FOMC, and that's why the markets are feeling pretty good.
Yeah, but are they feeling too exuberant? We're talking about 20 months of bull market territory, right? Are you paring back some of your bets in U.S. equities, maybe favor other markets that haven't done too well?
So the overnight session was pretty positive for the U.S. equities, but you're right. If we are right about the forecast for inflation, that certainly implies slightly lower pricing power for the U.S. corporates going forward. And we're talking about one of the most expensive markets. So we do think it makes sense at the portfolio level to start thinking about broadening the equity exposures to different types of trades outside, the small set of stocks in the U.S. that have performed very well. So we are still open-minded about the upside for the U.S. equities because the fundamentals are pretty strong. But when you, position tactically going forward, we think it makes sense to start thinking about a more cyclical and value opportunities outside the U.S. And this is the reason why recently we neutralized our tactical overweight in the U.S. equities in favor of other markets such as the UK.
Yeah, talk to us about some of those international markets that you see opportunities.
So we are now favoring, we have a slight overweight in UK equities. So this is the market where the policy will be clearer going forward. We have the election coming up. And also, it's one of the cheapest markets within the developed market space. And macroeconomic conditions are actually improving. So that points to some scope for a further earnings upgrade. So within the developed market equity space, this is one market that seems pretty interesting for us. And of course, it's a bit of an optionality trade on potential rotation within the equity market happening in next 6 to 12 months. So we like this market compared to the other markets. But for the Eurozone equities, we're still slightly underweight because of the weaker fundamentals there. They will likely require slightly greater cuts by the central bank, at least compared to the U.S. So slight overweight UK, slight underweight Eurozone equities.
You're still below consensus when it comes to China, though.
So we still expect 4.7% GDP growth for 2024. We've been maintaining the forecast for a while. Initially, it was actually above consensus, but due to pretty healthy first quarter GDP growth figure, the consensus has moved up. We acknowledge that there is a bit of upside to our forecast for 4.7% for the year, especially because exports have been pretty strong. The demand outside the country has been actually improving quite a bit. And also, due to potential tariffs down the road, it seems that producers are actually ramping up their activities. So this will add a bit to the growth. And for sure, the landing zone for Chinese growth after very strong first quarter will be slightly higher than what we expected. However, the real estate sector is still under significant pressure. And there are uncertainties about what kind of policy that the third plenum can deliver in July. So with those uncertainties in mind, we are comfortable to be slightly more cautious. And for the market, we remain neutral.
Homin, just quickly set the ground for us for the BOJ policy decision tomorrow. Can you remain constructive if we get more signals of tightening this year?
So we are still pretty convinced that the Bank of Japan will tighten further. We are currently penciling in 2 rate hikes, July and December, 10 basis points each, and also paring down of the bond purchases, which the BOJ seems to be indicating through these media reports. First quarter, there was a bit of setback, but we think the domestic demand will start rebounding into the second quarter. In fact, we see that already in the industrial production numbers and the retail sales numbers and the business surveys. So if that's right, and certainly it points to continued wage growth gains. We have seen the positive spillover from the Shunto negotiations to nationwide wages, and inflation will actually pick up a bit in the second half of the year because subsidies for energy will end. So in that kind of context, it makes sense for the Bank of Japan to tighten further. And of course, they remain sensitive to the dollar-yen movement. So the sequence that we envisioned in immediate reaction to the Bank of Japan move in March, which is Finance Ministry buying some time with the FX market interventions, and then BOJ following up with tightening, we still stick to that scenario. And we are pretty confident the Bank of Japan will tighten a bit further starting in July.
Homin Lee, always great getting your insights. Senior macro strategist at Lombard Odier. We have more ahead on the Asia trade. This is Bloomberg.
take a look at how we're trading across US Treasuries this morning, as we did see quite a few sort of oscillations across the market, trimming gain zone now, with the Fed and traders really split on 2024 rate cuts. Of course, we heard that the Fed reducing the number of projected rate cuts this year to just 4 by the time we get to 2025. Really at odds with the markets, though, which is still favouring 2 quarter-point cuts, even as the Fed continues to project 1. Jay Powell saying the actual path for rates is, of course, still data dependent. But if you take a look at swap contracts predicting Fed decisions, they're still, in contrast, factoring in rate reductions in November and December. September odds just fading slightly. Well, Bloomberg opinion columnist Mohamed El-Erian says it's unclear if the Fed reflected the latest inflation print in its rate decision. He told us that disconnect between markets and policymakers is growing.
I was surprised to hear that 4 voted for no cuts, and I was surprised to see the inflation numbers go up, both for the PCE, both at headline and core. So the one question I would have for Chairman Powell is, do those numbers and the expectations that 4 people had of no rate cuts reflect this morning's inflation data or not?
Somebody today echoed Peter Orszag, a long time ago of LSE. That's a school a Mohamed southwest of Cambridge. And Peter Orszag talked about glide paths. Is our great underestimation that the glide paths to get out of the pandemic with all this monetary policy is a much longer time frame than we think? We're modeling Fed meeting to Fed meeting, the silliness of September and December, where we should be modeling 2027.
We should, Tom, and I've been urging to combine data dependency with more of a forward-looking view of the economy, but that's not where the Fed is, and as a result, that's not where the markets are. The markets are reacting to every single data point. In the last month, just the last month, 10-year yields went up 30 basis points, came back down 40 basis points, went back up 20 basis points, and came back down 40 basis points. And what you realize is that there's no anchor. There's no longer-term anchor to markets, and there's no longer-term anchor to policies. We should be talking about the big secular changes and how that's going to impact the next 12 months. But that's not where the Fed is, and therefore that's not where the markets are.
Right now, I wonder how significant it is to you, Mohamed, that we did see at least one participant materially mark up their long-term neutral rate as people try to understand what this means longer term for what a Fed rate cutting path could look like.
It's about time. I mean, there is a very active discussion of what's happening in the structure of the economy and why it is that the neutral rate is well above 3, nearer to 4. But the Fed is moving very slowly on this, and Fed Chair Powell has refused to engage in discussions, either saying, I don't care about it, or I don't have a view about it. So, yeah, it's about time. They're going to have to really think about this. But again, Lisa, that is a forward-looking parameter, and this is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
Bloomberg opinion columnist Mohamed El-Erian speaking with Tom Keene and Lisa Abramowitz. And it's time now for morning calls ahead of the Asia trading day. BlackRock's Jeffrey Rosenberg is warning investors that they risk losing out on income by staying in cash. He believes treasuries maturing in 2 to 5 years are more attractive investments. His comments came after the Fed signaled more cuts in 2025. Rosenberg also says he sees a very supportive market environment for credit. Now, Bank of America's Savita Subramaniam says that as the economy recovers, things are, quote, kind of awesome for U.S. stocks. She says even though some data points have softened, most measures of the U.S. economy are normalizing from unsustainably lofty levels rather than pointing to a slowdown. Still, she's sticking with a year-end target for the S&P 500 of 5,400, which Haidi, of course, we've already topped.
And Shery, energy aspects founder Amrita Sen thinks OPEC plus countries will probably not raise oil output this year. That's even, of course, after the group unsettled markets after it unveiled plans to gradually start restoring output from October. Sen believes the plans won't happen without a ramp up in world oil demand. She sees it growing by 1.1 million barrels a day this year. So take a look at how we're tracking when it comes to some of these major commodities, including the energy space. And we have seen a bit of a steadying when it comes to trading in crude prices, a little bit softer for New York crude, but certainly we've coming off the back of that 3-day advance to investors weighing that unexpected build-up in American crude stockpiles. We're also getting the outlook, of course, for Fed policy, expected now to be tighter for longer. We've seen WTI kind of close to 78 barrels, climbing almost 4% so far this week. We've seen, of course, that jump in US crude inventories by 3.7 million barrels last week. And of course, that was a surprise given the previous report has suggested a decline. Also watching iron ore. Vale's CFO says demand out of China is strong. We have seen that kind of bounce back from the lowest since April levels on these hopes that the property sector might finally be turning a corner. More ahead here on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade. The latest corporate developments, Broadcom shares jumped in late trading after its latest results and annual forecast topped estimates on the back of robust AI demand. The chip supplier to Apple sees full-year sales at about $51 billion, a touch higher than the average analyst estimate. CEO Hock Tan expects total AI sales for the year at over $11 billion. OpenAI CEO Sam Altman has told staff the company is on pace for $3.4 billion of annual revenue. A source says he told an all-hands meeting that the vast majority of that revenue is coming direct from products and services. Altman also said OpenAI was on track to generate about $200 million by offering its AI models through Microsoft Azure. Samsung Electronics has unveiled advancements to its technology aimed at luring makers of AI chips to its manufacturing business. The company laid out the chip making and AI roadmap at its annual Foundry Forum in California. Samsung says it'll continue to make those efforts. We'll have more in the next hour. This is the Asia Trade. We're counting down to Asia's major market opens. Of course, Haidi will be watching the biggest central bank decision still remaining, which is the Bank of Japan, after we already got the FOMC out of the way. And as expected, it was a hold. But the key takeaway, one rate cut this year expected instead of 3 just in March.
You wouldn't think that, judging by the market expectations and the market reaction, right? We see swaps really still pricing in November, December, and even September just fading a little bit. But as you say, BOJ front and center, and I always keep a little bit of space for a potential BOJ surprise.
I think we'll be watching very closely those debt purchases and a potential reduction on that front, because it seems when it comes to a hike, most investors right now are pricing in perhaps a July rate hike. But given that we're watching those debt purchases, we're watching JGBs very closely. The 10-year yield is back down below that 1% level. We are watching the Japanese yen, not a lot of movement. And of course, depending on what happens tomorrow, we could see a big reaction there. The Nikkei coming online up 0.9%. And really, we saw that pressure on the Nikkei in the previous session as well. PPI numbers actually surprising to the upside this week, sort of perhaps complicating the picture for the Bank of Japan as inflation accelerates. But take a look at how the cusp is opening right now. We'll be watching Samsung is one stock. Of course, we'll be watching the broad tech space as well. The Korean won right now strengthening a little bit around the 13.60 1,369 level, but we're very close to that 1,400 level that traders are watching very closely. The cusp was one of the biggest gainers in the previous session and continues to extend gains more than 1%, Haidi.
Taking a look at how we're setting up when it comes to the first couple of minutes or so of trading here in Sydney. A little bit flat at the moment. The ASX just taking some time, of course, to come online in that staggered open. The Aussie dollar is holding up actually pretty well, 66.65. We've seen that rebound of iron ore prices off the lowest since about April on these hopes, founded or not, that we could be seeing a bit of a turn towards a positive for China's property sector, right? Also watching treasuries. Of course, we had the reaction to both CPI and the Fed decision and how trimming some of those gains there. But as I mentioned earlier, we're seeing a big split with traders versus what we're hearing from Jay Powell himself and the FOMC in terms of expectations of how many cuts and when they potentially take place. Take a listen.
We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having, the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
Well, the Fed, of course, now are just expecting one cut for 2024, as has been our next guest, actually. Joining us now in Sydney is Alexander Wolf, who's the Asia Head of Investment Strategy at JPMorgan Private Bank, and such a pleasure to have you here in Sydney, Alex. So bond traders are loading up on rate cut bets again. We've seen, obviously, equity markets going in the opposite direction and hitting all-time highs despite the Fed. What do they know? What are they hoping that they know that the Fed doesn't?
Yeah, well, I think when you look at this year and you look at what the bond market has been pricing, it's been quite volatile. I mean, you have to remember we came into the year, which isn't that long ago, with the market expecting six or seven cuts. And so that has adjusted, and it's still trying to figure out exactly what the path is going to be. And it's tricky because it's an election year. You have still very noisy inflation. And our view is that they can wait. They can afford to be patient. And there's no really strong signal that they have to cut soon, with still some progress, but still some noise around the inflation print. And they'll likely just err on cutting a bit later, and that's why we're expecting just one cut in Q4.
Could they potentially not cut at all? Because we were talking earlier about, potentially the fiscal spend that comes with the US election, which could make the Fed's job a whole lot harder, right? And how do you invest around that sort of scenario? Yeah,
I think in terms of this calendar year, potentially. I mean, there's always the chance that they wouldn't cut. Though when we look at real rates, and they are quite high. So rates are restrictive in terms of real rates, much higher than what the Fed wants. So we think cuts are definitely coming. It's just a matter of whether they start this year or they start next year, and then how much we see next year. And I don't think they can really accurately plan around what fiscal policy might be in a next administration, because you don't know the makeup of Congress, and you don't know then whether the Trump tax cuts will be allowed to expire or not. You don't know if you'll see an additional increase of spending or additional tax cuts, because it's really going to depend on the full composition of the government, and it's just impossible to predict that.
Yeah, so how do you constructively invest around that uncertainty?
Yeah, I think we will, when we look at what fiscal policy might look like, almost set that aside, and then just try to understand the underlying fundamentals in terms of what does the growth outlook look like? How much strength are we seeing in terms of the underlying economy? What is the path of inflation, especially some of the components that kept inflation high, whether it's rents or the labor market or some aspects of insurance? Try to factor that in, more or less putting the election aside in terms of any of noise we could see and changes around fiscal policy, and then assess it that way and say what is the right path for rates given that.
Would you buy on dips when it comes to U.S. equities at this point, given that we've already rallied so much?
Yes, we would. And that's largely on the view that we think underlying earnings are likely to remain fairly healthy. And the key driver hasn't necessarily been either valuations or multiples up to this point. It really has been earnings. And even Q1 earnings have come in quite strong, with a number surprising above consensus expectations. So we definitely would. We're a bit more selective, but we still do like tech. We still do like broad U.S. equity. So yes, yeah, we would be buying on dips.
How selective are you about Japanese equities? I've heard so much optimism about this structural change in the market, but at the same time, we're setting up for tightening coming from the BOJ this year.
Yes, we still do like Japanese equities. And again, it's largely on the similar story to the U.S. in that we actually expect Japanese equity earnings to be amongst the highest in terms of earnings growth within developed markets. And when you think about the BOJ, yes, we are expecting rates to rise, but still from an extremely low base. And we expect monetary policy to still be very accommodative in that real rates are still very deeply negative. So even with a very gradual path of hiking, don't expect that to necessarily upset the market. And then the overall outlook in terms of growth, in terms of reflation, especially from a nominal growth perspective, it still does look quite positive.
We haven't really seen that consumption rebound that we were hoping for here in Japan. Given the fact that domestic consumption still remains muted, but it seems manufacturing is doing okay given the weaker yen, is that sort of the positioning that you're going in assets across Japan?
That is the exact thing I think that investors should be looking at right now. So you're right in that the recovery so far, the growth driver right now is really business investment, and consumption has remained fairly weak. We think it's largely because disposable income got compressed as prices rose, but wages didn't. There was a lag between prices rising and then that feeding through into higher wages. Now, as we see wage growth picking up, we are expecting consumption to pick up. So as that cycle of higher prices and higher wages driving higher consumption, we expect that cycle to really pick up. But that is going to be the key thing to look at. If households just save more of their income and they don't spend more, then that could really derail this positive outlook. That could derail the view that nominal growth is going to pick up. But that really is the key variable, I think, to watch.
I wanted to talk about China because you say that this is the time to trim that exposure as we've seen that rebound, right? And I want to actually bring up a chart that we made up from your notes showing really how most of the demand in H-shares is coming now from mainland investors. How much exposure do you want in China at the moment, and do you believe in the property recovery story?
So we think you should have some exposure, certainly. But when we're thinking about it as just another country within the benchmark, think about it relative to the benchmark. And so we're okay with neutral, even maybe a slight overweight, but trying to push back against some very significant overweights or home bias that we see across the region, and also focus it more on the onshore exposure versus the offshore exposure. Onshore hasn't rallied as much as the offshore. In terms of property, no, we're not expecting a rebound. We're not expecting a rebound. There's still a lot of vulnerabilities in terms of unsold properties, in terms of properties still under construction that haven't been finished yet. And so the policy shift that we've seen so far maybe could put a floor under the downturn that we've seen, but not enough to really cause a rebound in our view.
Would you rather be looking at those flows going back into India?
We have seen, so in terms of global flows, there's been outflows out of India since April. And some have gone to Japan, some have gone into developed markets. I think now that the election is done, and historically post-election you do see a market rally, that we could see some of those flows go back in. Now that you can see how the government is being formed, and there's not that uncertainty around what the election is going to look like, that we could see some flows going back in India.
Yeah. Okay.
Right, Alexander Wolf, great to have you with us. Asia Head of Investment Strategy at JPMorgan Private Bank with his calls on the markets as we continue to watch some of the big movers across the early Asian trading session. We're watching chip makers. We did get Broadcom's results, and they really surprised to the upside. That included their annual forecast. Remember, Broadcom is a chip supplier for Apple and other big tech companies, and they actually saw robust demand for artificial intelligence products. We're also watching Samsung, which is gaining about 2% at the moment. It unveiled a number of coming advancements to its tech aimed at luring makers of AI chips to its manufacturing business. Of course, Samsung is the world's #1 memory chip maker, and it's been sort of trying to catch up with TSMC when it comes to the foundry market. So Samsung unveiling that chip technology, lots of hopes on what that will mean for the business, but right now gaining more than 2% on the cusp, Haidi.
Still ahead, the Bank of Japan, Shery, widely expected to consider reducing its bond buying at a policy meeting about to get underway. We'll assess the chances of further monetary easing with a former finance ministry official. But first, trade war fears escalating as China threatens retaliation for higher EU tariffs on its electric vehicles. We have the details next. This is Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m., only on Bloomberg Television. Context changes everything.
Take a look at how Asian EV makers are faring in light of the announcement that the EU is set to slap tariffs of up to 48% on EV imports from China. We've had this investigation, of course, underway for Chinese subsidies for their EVs. It's a move to cut imports to raise EV prices for consumers, according to some analysts there. So those additional tariffs to as much as 48% really threatens to escalate trade tensions and adding to the costs of buying an EV ultimately. We're seeing sort of a picture of two markets there. The Korean EV makers are doing quite well. We also have, of course, the anticipation that Korea may consider changes to the short selling rules on Thursday as well, with those ongoing discussions. But Japanese car makers Toyota, Honda are seeing a broadly lower day today. Perhaps unsurprisingly, Beijing has blasted the EU's move to slap extra tariffs on Chinese electric vehicles, raising levies to as high as 48% from next month. The Commerce Ministry says the EU is ignoring the facts as well as WTO rules. Our China correspondent Min Lo is with us in Hong Kong. So Min, SARC, the hardest hit. We'll see if that's the biggest to react to. Why is that, though, not BYD?
Yeah, well, the official reason is that SAIC, which is a state-owned company, was the least cooperative with the investigation. But also, the EC President Ursula von der Leyen had previously said that they are taking a tailored approach to calculate the tariffs to correspond with the level of damage caused. And we know SAIC owns the British origin brand MG, which is making the biggest headway in Europe. It sold over 200,000 cars in Europe last year. BYD, however, is trailing far behind at just 16,000 cars in Europe last year. And that perhaps speaks to some of the resistance that European consumers face in terms of consumer taste, perhaps not willing to buy a very purely, distinctly Chinese brand. And that could be why SAIC is facing the largest tariffs here.
Mimin, Tesla has pushed back against those tariffs as well. How does that play in here?
Yeah, Tesla is pushing back because these tariffs, they don't just apply to the 3 EV makers that have been investigated by the EU. Other EV makers will face tariffs that are a weighted average of these 3 car manufacturers that were investigated. So the weighted average is 21%. For those who did not participate and cooperate in these investigations, they'll face a highest tariff of 38%. That's on top of the existing 10% tariffs. So Tesla is pushing back against this because actually 37% of EU's electric vehicles come from China, but nearly half of those are made by foreign brands like Tesla, BMW, Renault. And so Tesla is pushing back. They are one of the leaders when it comes to export of EVs from China into EU. They're asking EU officials to conduct an individual review of tariffs on Tesla. They're arguing that they do not benefit from as much state subsidies as the Chinese manufacturers.
What are we expecting the net impact to be on the EU? I mean, will they be able to achieve the desired effect? Because at the same time, China is now threatening retaliation.
Yeah, indeed, because I mean, look, these Chinese EVs, they are facing a very brutal trade war, price war, in China. So they really need the overseas market where they can sell these cars at a more expensive price for greater profit margins. So suddenly these tariffs, they are going to eat into the profit margin for these Chinese manufacturers. They may have to raise their prices by 5 to 15% in Europe just to make up for that losses. That's going to make their cars less attractive. We have a study from the Kiel Institute for world economy that's based in Germany, estimating that we would see a halt of nearly $4 billion worth of EVs from entering Europe from China. So that's a huge impact there. But I think the long-term impact, though, is that we could see a shift in supply chain towards Europe, with companies like BYD already looking to set up a plant in Hungary. They're perhaps looking to set up a second plant elsewhere in Europe as well. The Chinese EV brand Shery is looking to set up a joint venture in Spain. And there's also Geely, who is shifting production to Belgium as well. France, we know, has been trying to attract more battery production to its country, including from Chinese manufacturers. So I think that could be the long-term plan, as well as the intention for these tariffs as well.
There's a lot of concern about a revived trade war. Could Beijing retaliate, and what would that look like?
Yeah, Beijing has already reacted very strongly to these tariffs. They have said that this is a weaponization of trade issues, that they do not have legal and factual basis. We know China has previously hinted that they could impose a 25% tariffs on vehicles with large engines. That could hit car manufacturers like BMW, Porsche, Volkswagen, and these are the companies that have been more outspoken in criticizing the EU tariffs. The German Chancellor as well has been criticizing those tariffs, saying that Europe should not close its markets because they do not want the same treatment for European manufacturers overseas. And Beijing has previously also hinted that they could impose tit-for-tat levies on European dairy products, its agricultural goods, aviation as well. So Airbus could perhaps be in the crosshairs, because we know Airbus was recently negotiating a huge deal with Chinese airliners as well. So analysts are saying that we will see retaliation, but perhaps it will be a proportional retaliation rather than an escalatory one, because China will still want to maintain a sort of middle road, because ultimately Beijing and Europe, they need each other.
Sure, we'll continue to see that cautious approach from both sides, right? Bloomberg's China correspondent Min Lo, because we'll continue talking a little bit more about geopolitics and the pressure that China is facing. The group of 7 leaders looking set to call on Beijing to stop enabling and sustaining Russia's war against Ukraine when they meet in Italy from Thursday. That's according to a draft statement seen by Bloomberg. The document says Beijing's support for Moscow's defense sector has broad security implications. In response, the Chinese Foreign Ministry says Beijing is not a party to the Ukraine conflict. U.S. Secretary of State Antony Blinken has cast fresh doubt on the prospects of Israel and Hamas agreeing to a ceasefire proposal put forward by the U.S. He says the militant group wants changes to the plan endorsed by the UN Security Council, calling some of the latest demands unworkable.
Hamas has proposed numerous changes to the proposal that was on the table. I believe those gaps are bridgeable. Doesn't mean they will be bridged. We are going to continue to push on an urgent basis with our partners, with Qatar, with Egypt, to try to close this deal.
More ahead on the Asia trade. This is Bloomberg.
We do have some breaking news when it comes to PAG. This is Asia's largest manager of alternative assets, announcing that they'll close their latest fundraising buyout at $4 billion later this month. That reached less than half of its original target. Investors are balking at putting new cash into the region. People familiar with the matter telling Bloomberg. This fund, of course, was launched 2 years ago. PAG was seeking about $9 billion for this fund. The firm last year told investors it was anticipating raising $6 billion. The world's biggest pension pools are increasingly reluctant to put their money into these illiquid assets in general, according to these sources. They started marketing that fourth fund in the first quarter of 2022, and this is an industry that's faced some pretty massive challenges, right? The prolonged low level of exits by Asian asset managers just being one of them.
And Haidi, take a look at how treasuries are looking right now because we continue to see the downside in yields, the 10-year yield losing ground in the Asian session as well. We are now seeing it headed towards that 4.3% level. We have seen some of those losses being trimmed after the Fed reduced the number of projected rate cuts this year just to 1, but we continue to see the downside pressure as we are now headed towards the BOJ policy decision as well. The Bloomberg opinion columnist Mohamed El-Erian says it's unclear if the Fed reflected the latest inflation print in its rate decision. He told us the disconnect between markets and policymakers is growing.
I was surprised to hear that 4 voted for no cuts, and I was surprised to see the inflation numbers go up, both for the PCE, both at headline and core. So the one question I would have for Chairman Powell is, do those numbers and the expectations that 4 people had of no rate cuts reflect this morning's inflation data or not?
Somebody today echoed Peter Orszag, a long time ago of LSE. That's a school of Mohamed southwest of Cambridge. And Peter Orszag talked about glide paths. Is our great underestimation that the glide paths to get out of the pandemic with all this monetary policy is a much longer time frame than we think? We're modeling Fed meeting to Fed meeting, the silliness of September and December, where we should be modeling 2027.
We should, Tom, and I've been urging to combine data dependency with more of a forward-looking view of the economy, but that's not where the Fed is, and as a result, that's not where the markets are. The markets are reacting to every single data point. In the last month, just the last month, 10-year yields went up 30 basis points, came back down 40 basis points, went back up 20 basis points, and came back down 40 basis points. And what you realize is that there's no anchor. There's no longer-term anchor to markets, and there's no longer-term anchor to policies. We should be talking about the big secular changes and how that's going to impact the next 12 months. But that's not where the Fed is, and therefore that's not where the markets are.
Right now, I wonder how significant it is to you, Mohamed, that we did see at least one participant materially mark up their long-term neutral rate as people try to understand what this means longer term for what a Fed rate cutting path could look like.
It's about time. I mean, there is a very active discussion of what's happening in the structure of the economy and why it is that the neutral rate is well above 3, nearer to 4. But the Fed is moving very slowly on this, and Fed Chair Powell has refused to engage in discussions, either saying, I don't care about it, or I don't have a view about it. So, yeah, it's about time. They're going to have to really think about this. But again, Lisa, that is a forward-looking parameter, and this is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
That was Bloomberg opinion columnist Mohamed El-Erian. They're speaking with our colleagues Tom Keane and Lisa Abramowitz. Still ahead here, why Columbia University's Takatoshi Ito thinks the BOJ may raise rates twice more this year. We'll get a preview of that decision next. This is Bloomberg. We're about 30 minutes into the market opens in Asia. These are the top stories that you should know. China's Commerce Ministry has slammed the EU's move to slap extra tariffs on its electric vehicles. The setback for Xi Jinping's pivot to new productive forces. Those extra tariffs will take levies to as much as 48%. Bloomberg NEF sees a sharp decline in the meantime to the global transition to electrified transport. Markets are going risk on with US stocks hitting fresh all-time highs. That's after the Fed kept rates on hold as inflation cools, while dialing back easing forecasts, penciling in just one cut this year, 4 in 2025.
We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
focus now shifting to the Bank of Japan meeting, which is widely expected to consider slowing the pace of bond buying. Investors will also be on watch for any signals of a possible rate hike in July. All but one economist surveyed by Bloomberg expects the BOJ to hold its benchmark rate on Friday.
And of course, there's really a big focus when it comes to potential changes in debt purchases. So we're watching JGB yields very closely. The 10-year yield under pressure again, and we're now back below that 1% level. We have seen it, of course, really fluctuate around those levels, but the focus right now really what happens to debt purchases. And our next guest expects the BOJ to scale back that bond buying when it makes its policy decision tomorrow. Joining us now is Takatoshi Ito, professor of international and public affairs at Columbia University. He's also a former official with Japan's finance ministry and the IMF. Professor Ito, always great talking to you. So give us a little bit of your reasoning why you expect some changes in the bond purchases and what sort of implications that would have for policy.
Yes, so BOJ is becoming very confident that the Japanese economy, both the inflation, GDP, those numbers are doing well. And so raising the policy rate and or the reducing the purchase of the JGB, those are the two policy options that they're considering. And given the some complaints that yen has depreciated too much, that it makes sense that the BOJ would reduce the purchase amount of the JGBs. I think that's what they are considering seriously.
How much of a reduction are you expecting, and does it matter which bonds they will be targeting, especially at a time when we've been also closely watching those regular bond purchasing operations? Does that sort of give you a hint of where they might be headed?
Well, right now, BOJ is buying about 5 to 6 trillion yen monthly. However, that amount includes the rollover of that maturing JGBs. So pure increase of the JGB holding is about half of that, or 3 trillion. So reducing by half to 3 trillion would mean that JGB holding would be flat. So it's tapering, in a sense, complete tapering. And if they reduce to zero, it's QT, that quantitative tightening, although BOJ doesn't like that word, tightening. So I think it'll be gradual. It's not sudden change from 6 trillion to zero. I think it's going to be reducing gradually toward zero. And if there is any turmoil in the market, they will reassess the reduction speed.
Governor Ueda really has to be careful about what he says this time around, right? Especially what happened after the April press conference. But as you said it, I mean, they're probably considering the yen, but they can't give an impression that they're acting because of the weakness at all. What will they need to do in order to lend some sort of support, but at the same time keep up appearances that the yen level is a finance ministry role? Yes.
So I should be very careful that they would not, BOJ would not say that they are changing a monetary policy because of the exchange rate. And it is, they will emphasize that is jurisdiction, under jurisdiction of the Ministry of Finance. However, I think the public opinion and government wish is in the direction that it is okay to raise rates and reduce the bond purchase which is very unusual from central banking the environment. So they would say they would not mention the exchange rate, but they can do data dependent decision, and that would have that would not have political conflict. That's what I wanted to say.
Professor, it really feels like the optimism is because of the view that the recovery is real this time, right? That we're finally seeing that exit from the lost decades after 30 years of stagnating growth. What could potentially put that at risk at this point?
Well, again, if the external shocks, including energy, geopolitical risk, and they are the number one risk. And number two is that the consumption is supposed to rise because the wages has a record high increase, and there is a tax cut starting this month, and so consumption is supposed to go up towards the end of this year. However, if the scenario doesn't take place, then that would be a risk for the real recovery. The companies are doing well. Stock market is doing well, and real estate markets are doing well. So, the underlying force is positive, but the weak part is the consumption.
Yeah, as you mentioned, the weak links, households are not doing particularly well. Labour market productivity is not doing particularly well. So, are these things that the BOJ can fix? It's, demographic for sure, right? So is this down to the BOJ, or is it more down to more structural reforms required from the government?
Yeah, BOJ cannot do much about demography or the consumption decision, or the wages. So it's up to the government, and this year's Council of Economic and Fiscal Policy report will come out soon, and they should be responsible for making this recovery going and steady, and change this the consumer confidence up.
Are you optimistic after what you saw from the Junto wage negotiations and how much they filter through when it comes to pay growth, not only for the past month, but that's expected throughout the summer, right?
Right. So I think wage increase is definitely a positive news, and I think the workers start to feel that their take-home pay is increasing, and question is that whether this translates into the consumption increase, and I feel that young people are much more conservative, cautious in going to spending spree, and they worry about their future. They're pessimistic about public pension. They're pessimistic about their job promotion. So we need to change the labor market mobility, and I think the promotion speed of those young people, and increase the defined contribution pension plan in addition to public pension defined benefit. So the defined contribution system will be reformed. That's on the agenda. So that will make the confidence for the young generation that their future is bright, I hope.
Takatoshi Ito, great to speak to you always ahead of that big BOJ decision. Professor of International and Public Affairs at Columbia University, setting the ground for that policy decision that we're getting on Friday. And let's delve a little bit deeper into the Japanese economy and perhaps talk a little bit about the sectors that could be benefiting. Bloomberg Intelligence Senior Industry Analyst Takeshi Kitaura joins me now here in the Tokyo studio. And Takeshi, as we're talking with Professor Ito about wage growth, what do you make of the different sectors and industries in Japan that could be potentially benefiting more than others?
So I think Japan has traditionally been a hardware-oriented economy. Shift from that to software is digitalization is one trend. So Hitachi, for example, just announced they will be training 50,000 people to be capable of using generative AI. So I think these trend into new technology will be boosting the company's growth potential going forward as well.
Japan's refocusing production when it comes to high-end chips. So what do you see as some of the strengths and the challenges on this?
So I think for high-end chips, I think the challenge will be to produce the 2-nanometer chip that their Rapidas is currently trying to develop because they haven't had the experience in doing the 7-nano or the 5-nanometer technology. However, Japan continues to hold a lot of the strength in, for example, chip-making tools like Tokyo Electron, and also materials, including the wafer and capacitors as well. So I think companies like Shin-Etsu or Murata will continue to benefit from a strong capability to support the industry from the bottom-up angle.
And one of the industries that's been supported, of course, has been the defense industry, given the geopolitical tensions that we continue to see. So what developments are we seeing in that sector?
So it's pretty clear. One is the sales. And for sales, for example, Mitsubishi Heavy expects their defense-related sales to double over the next course of 3 to 5 years. This is based on Japan's government expanding their spending from 1% of GDP to 2%. In the next 3 to 5 years. The other is the margin. Defense has traditionally been relatively low margin for some of these defense contractors, but it doesn't help to maintain the supply chain, which has been a crucial issue as the geopolitical tensions increase. So going from mid-single-digit margins to double-digit potentially is the sort of the trend we're seeing. And talking to a lot of companies, that it's already happening on a order term. So that flowing into the actual finances over the next course of the year or two will be pretty important.
Which kind of takes us back full circle to the broader Japanese economy, right? Because we're talking about all of this optimism when it comes to different sectors and industries, but at the same time, as we were talking to Professor Ito, household consumption, wage growth has been improving, but still consumption has been lagging. Overall, when you look at Bloomberg Intelligence's research, are you seeing a sustainable inflationary environment now?
So I think whether it's sustainable is all the work that we have to do from here on. And first is continuing the wage hikes. So giving the economy the confidence to actually spend. After a couple of decades of really low spending, it doesn't come back in a year, right? So continuing that. And also profit growth from companies will flow back into the economy. So the good cycle needs to happen from going forward.
Hopefully that profit will actually filter through and not just being hoarded, as we have seen Japanese companies really sit on that hoard of cash, right? Takeshi Kitaura, thank you so much. Great research from Bloomberg Intelligence. He's an industry analyst there. And we take a look at the Kospi year to date. We have seen, of course, those massive gains in the previous week, and we continue to see that upside right now of more than 1%. A lot of optimism over the chip sector, exports improving, and you can see year to date we're seeing gains of more than 4%. So we are set now for a new 2024 high. Coming up, Bloomberg Intelligence reporting that China's pet economy is set to outpace the nation's GDP growth. More on those findings next. I'm really looking forward to hearing that one. This is Bloomberg.
Well, China's pet sector may be defying the economic downturn in the country, with a new report by Bloomberg Intelligence seeing it hitting nearly $50 billion by 2030. That's as fur babies emerge as a new proxy for children. For more, we're joined by our senior analyst, Ada Lee. So, Ada, tell us a little bit more about what you're seeing in terms of the key growth drivers for this pet economy.
Absolutely. So based on our research, we're expecting China's pet economy to grow at about 6% a year to 2030, reaching almost 50 billion US dollar in 2030. That is almost double the growth of the expected GDP growth in China. And the key growth driver could be some of the demographic changes that we're seeing in China. As people are more reluctant to get married and have children, they are shifting their focus on the furry babies, as well as, increase in household income and people willingness to spend on their pets because they view their pets as part of their families.
I know, who wouldn't be able to understand that, right? Our fur babies. I just can't wait to bring Bobby Bop-Ups here to Japan. But really, it's been exciting being around Tokyo and seeing all of these tiny strollers that are being taken around. And when you look inside, they're not babies. There are dogs and cats in there. So can we expect that growth trend in China to be replicated here in Japan as well?
Well, absolutely, in terms of those strollers. In fact, those are some of the top-selling products in the pet category as people,
yes, because I'm going to get one very soon now.
Oh, fantastic. Well, in terms of Japan, it is actually very interesting dynamic because we're seeing similar demographic changes, right? We're seeing decrease in fertility rate, decrease in marriage rate. In fact, there are more animals than kids under the age of 15 in Japan at the moment. But what we are seeing is Japan may not see similar trend in China because of the muted household spending. So in terms of the consumption pattern, it is slightly different to China. Also, when you look back in history, back in 2003 already, Japan has already experienced a pet boom when the number of cats and dogs for the first time outnumbered the number of children in Japan. So we think that Japan may be heading for a more steady growth, although the aging population and increasing number of single people could still boost the pet economy.
What are we seeing in South Korea?
Well, in terms of South Korea, once again, demographic pattern also very similar to that of Japan and China, with declining marriage rate and birth rate. But in South Korea, we are still expecting to see a lift in the pet spending, and that is on the back of some government-led initiatives, such as removal of value-added taxes on essential vet services for pet owners, and also improve in pet ownership environment. So in South Korea-wise, we are actually seeing a lift contrary to what we are expecting in Japan.
Yeah, I still need more of a better environment to bring our pets. I want to bring them to work. Bring your pet to work day should be a thing. Ada Lee, great to have you with us. Great story from Bloomberg Intelligence. She's a senior analyst in Hong Kong, telling us about the pet economy and dogs and cats and everything we can expect in that sector. This is Bloomberg.
Take a look at some of the latest corporate developments we're following. In Broadcom, shares jumped in late trading after its latest results and an annual forecast topped estimates on the back of robust AI demand. The chip supplier to Apple sees full-year sales of about $51 billion, a touch higher than the average analyst estimate. CEO Homin expects total AI sales for the year at over $11 billion. Fired SpaceX engineers have filed a lawsuit against Elon Musk in a California state court, alleging sexual harassment and retaliation. 8 former employees say Musk posted sexual photographs and demeaning commentary and chose to fire employees for speaking up. SpaceX has previously denied wrongdoing and said that Musk was not involved in the workers' terminations. Vietnamese car maker VinFast is pushing ahead with its Asia investment plans. The company says it expects to open its India factory in the first half of next year and to begin construction of an Indonesian plant within the next 2 months. The ambitious growth plan comes despite slowing EV demand and a tepid start to the company's foray into the US. Its parent group says it is still carefully considering that move.
There are many related issues that force us to consider this. For example, investors are afraid that we might invest too much. Interest rates are very high, while credit granting from U.S. banks is not as much as we had expected. On the other hand, there are also many positive things. For example, the sales speed in the U.S. market has increased a lot in the past few months. In short, all of these issues forced us to carefully consider the whole process.
Take a look at how the dollar has been trading. A lot of pressure given that we didn't necessarily see a change when it comes to the Fed not cutting rates, but also at the same time penciling in 1 rate cut this year. But swap market still pricing in 2 rate cuts for this year. So actually we saw a big reaction in the markets when the CPI numbers showed that the core data actually slowed to the slowest in more than 3 years. But of course, we're really headed towards the China market opens. And what we're watching are those EV makers, because the European Union will impose additional tariffs on electric cars shipped from China starting next month. And that could take tariffs to as much as 48%. Of course, this is really further escalating trade tensions. That's it from the Asia trade. Our markets coverage continues. The China Open is next. This is Bloomberg.